I'm Richard Bonnor-Moris, lead portfolio manager at Rivers Capital Management. We're going to start to do these videos as regularly as we think is appropriate to give an insight into how we're thinking about the allocation that we've got in place. Before I bring in Eduardo, I just wanted to point out the fact that the last 12 months we've had a great run. We've been running models now for 10 years successfully, which is all well and good, but looking back isn't really what we're focused on. What these videos are going to be about is not our performance or what we've done. It's looking forward, what we think is happening in the markets, and particularly Eduardo's views on what's going to change and why we're currently allocated as we are allocated at any time. Eduardo Tomacelli is the chairman of our investment committee, and him and I spend many hours chatting about where the world is, what the macro environment is. We talk about what risk level that we're at. We have this kind of framework around which we position the portfolios tactically. There's a strategic asset allocation, and we go over and underweight that strategic asset allocation appropriately based on what we think is happening in the world right now. So without further ado, this is Eduardo. Welcome.
Hi there. As Richard said, I chair the asset allocation, and we talk about what our strategic and market views are on a bi-weekly basis. As Richard says, we have a range of 5 risk levels. I beg your pardon, 7 risk levels, with 4 being neutral, and we're currently at a 2. And what's interesting is in the past, it's been fairly straightforward. We either think equities are risky or good value, and that tends to drive most of the asset allocation. We obviously look at credit and whether a credit is under or overvalued as well, and various other areas of the market, such as commodities, gold, sovereign bonds, and so on. But what's been interesting in the last year or so is that parts of the equity market have been much higher risk than other parts. So the risk and asset allocation has been much more nuanced, and our conversations have been much more about which areas of the equity market we need to avoid and which areas we need to focus on. And that's been slightly different, I think. And it's why we may be at a lower risk level, but in fact, we have exposures to equities. But within that exposure, we think they are the lower risk area of the equity market. So, for example, technology is quite high risk. It's more volatile now, but it has driven markets to a degree, mainly because of AI, because they are quite big and they are quite profitable. We have avoided those recently. It's probably a good thing for our risk-adjusted returns to have avoided those. And there are areas of the market which have been relatively good valued, such as industrials, commodities, oil and gas, areas which we've weighted more. And going forward, we believe this is the case, that and the stock market is telling us that it's quite narrowly driven. It's a small number of companies that have been driving the indices. When we look at the market as a whole, we look at it not just from a fundamental and valuation level, but also from a technical level or point of view, looking at the internal health of the market. And right now, there are a lot more new lows occurring, 52-week new lows, and there are new highs, which tells you that the internal breadth of the market is vulnerable. And so again, that reinforces our position of being currently underweight.
In terms of the technology, obviously technology is particularly the Magnificent Seven, I read yesterday that the US market is now 41%, or the S&P is 41% allocated to 10 individual stocks. These are pretty eye-watering or eye-catching at least. Do you think the multiples are the problem, or is it ultimately, do you think it's a bubble? Do you think, or is it a case of there are, that may continue? It's just in terms of opportunity, there are risks elsewhere that are more attractive.
It seems to me that it's a bit of everything. I think there's a case that earnings, sales, and revenues of these large tech companies, at least some of them, such as Nvidia, for example, some of the semiconductor companies, will play or have been playing catch up. So the valuations may not be quite as extreme as they appear. But in the case of the semiconductors, that is a cyclical business. So you apply a far lower valuation on a cyclical business than you would say on a Microsoft, which has recurring subscription revenues, which are far more highly valued. So there's the valuation aspect, which is only partly justifiable, but may well end up being unjustified. And then there's the fact that what's happening now is quite different from what was happening 10 years ago, in that these companies are now using significant amounts of their cash flow to spend in AI investment, which is not producing a return. And they're not only using their cash flow now, they're actually now raising debt. So the balance sheets of these companies are now looking risky. So whereas before it was just a valuation issue, it's now a valuation plus a balance sheet issue. So whether it's a bubble or not, I don't know. We'll find out. I suspect it's a whole series of factors which I think possibly might join at some point, and there might be an awakening maybe of the market where they go, well, hang on a minute, is the AI investment paying off? What is it? What is the total addressable market of this? But until that happens, these things might keep on grinding higher, might not. But what we think they might do on a price basis from a month-to-month point of view is largely irrelevant. They are sort of uninvestable right now, based on the approach that we adopt, which is it's got to be reasonable value, it's got to have good prospects, and it can't be a super volatile security. And they are manifesting that. And there's I remember back in the day when we used to think, gosh, if GE, General Electric, carries on growing like this, it's going to be the size of the US economy within the next 7 years. Well, sure enough, it stopped growing, and the stock went down quite a lot. And I remember people talking about Microsoft being the same thing back 20 years ago. And then it went through a 10-year consolidation period where the earnings caught up, to be fair, but it went from being a 35 times multiple equity to a low double digits. And then it became investable again because it was a good business. And then it's had, since subsequently the last 10 years, it's had a great run. So these things can change. They can collapse, or they can go through very long periods of consolidation where they do nothing. Kellogg's was another one, the cereal company. I remember consumer stock back in the 80s. Everyone thought, gosh, it's on 33 times and it's justified because it's going to carry on growing at 30% or whatever it was. Well, it didn't. It stopped and it went to 11 times. And it went through a very long period of consolidation. It went down quite a bit briefly, and then went through a very long period of consolidation, and then it started to outperform, but it wasn't particularly compelling. But I just remember in my 40-year career, there are these again and again, these things occur, whether it's in sectors or in individual stocks, and I suspect it'll be the same for these. We will look back and go, Nvidia or some of these AI stocks or Google, they weren't justified simply because there's a limit to which the revenue level can get to without it being more than the economy itself. And perhaps we're beginning to reach that point.
Yeah. Well, I mean, we could probably talk about that for hours,
Yeah.
especially given the IPOs that have been announced in the last week. But from our point of view, the standout allocation for the last 12 months, really, we have pretty much been underweight US tech for the last 12 months, but we've managed to keep up because of the allocation to diversifiers, gold, commodities, infrastructure, energy. But in an environment like this, obviously, there's the geopolitical risk. Do you still think we remain more comfortable in those areas? Because the valuations are still pretty compelling. And then there are other stories behind, particularly for gold. Could you just touch on a bit how you see the future for the diversifier, or what a lot of people would call alternative investments?
Yeah, I mean, I think we got into them, a while ago, and certainly for oil and gas, it was opportune, given what's subsequently happened in Iraq and in Iran and the Middle East. They have gone up quite a bit. They are not as compelling as they were. I'm talking about oil and gas and energy generally. However, if you were to ask me, is oil going to go back to $60? I suspect that's not the case. I think we've probably got a new long-term level of it, probably between 75 and 85, which is pretty good for oil companies. So I think whilst they're not compelling anymore, they're good value. They're certainly good value relative to some of the highly valued sectors of the market, and they're throwing off a lot of cash, and they pay back shareholders. They're far more disciplined than they used to be. So energy sector in general is okay. I think the precious metal side is harder because gold, I think, will simply reflect sovereign deficits and the amount of money printing and inflation in the system and so on and so forth. And so I think the drivers behind gold are still there. It's had a big run as well since we've owned it, and it's consolidating at the moment, having hit about 5,000 or over 5,000. So it's now in a consolidation period, and it could probably at some point resume its uptrend, I suspect. The gold miners are harder because they are, whilst they own the gold in the ground, which is a good thing. If all the precious metals in the ground, which precious metals are going up, then that's a good thing. However, it's much more expensive than it used to be to get out. So the earnings are under pressure there. So that again has made it slightly less compelling in terms of the miners, but for the actual metals themselves, I think the investment case is still pretty solid. And then the other stuff, things like nuclear, energy is more diversified now. There are other sources of energy, and the amount we use in terms of just oil and gas and coal, compared to 20, 30, 40 years ago is less. We do use more alternative stuff, and nuclear. And so there are other areas, there are other diversifiers within energy, which from time to time we look at. And so we certainly looked at nuclear. It had a run. It is more volatile, nuclear, and it is a smaller sector. So it's by its very nature riskier. But there's a future for that.
Yeah, it's quite difficult to find. We held it, well, we still hold in some portfolios uranium miners, but it is quite a difficult. I mean, because nuclear is so state-run, it's quite difficult to.
Yeah.
And the pipeline is obviously so long, it's difficult to predict. But I think it's fair to say that there is likely to be a shortage of uranium given the pipeline of nuclear power stations that are already planned. That's one of our theses for the last year. What I would say is in February, we added healthcare, right, to the portfolios as a diversifier, as a thematic. It's not played out very well, to be fair. The obvious, it's probably my call: demographics, AI innovation within healthcare, and the relative valuation look pretty attractive. Do you think that story still stands? Obviously, it may be related to the war in Iran, and the manager certainly pointed out that there seems to be a strange relationship between healthcare and energy, or an inverse relationship between healthcare valuations and energy. What's your view on that allocation going forward?
So yeah, from a short-term timing perspective, you're right. We could have done that better. There's no doubt. And in fact, looking back on it, just technically, I think we could have certainly timed our entry better. Having said that, it was interesting to see just a few weeks ago, or maybe it was last week, when the market had a brief correction, how healthcare went up. So there's obviously an inverse correlation here with the broad market, with tech and healthcare, just on a shorter term basis, which tells me it's a defensive sector. It yields, so it's probably at the moment uncorrelated with or correlated with bond yields, and so I think it's right because valuation wise it's right. As Richard said, AI could be a huge productivity boost for some of these big pharmaceutical companies in the R&D space. I mean, if some of the people I've listened to out of MIT that talk about the cost of R&D and the cost of bringing a new drug being reduced by potentially 80%, and bearing in mind nowadays to bring a new drug online can cost upwards of 5 or 10 billion, then that could be very, very significant for the likes of Pfizer and for big companies, Pfizer, Glaxo, which have got huge revenues, but if you increase the marginal cost of producing their product, that could be a big boon for the industry. So, I mean, patience, I think, for this one. I think it's got valuation driver, it's got a technology productivity driver. I think it's underowned. It's defensive, and I think there's certainly on a medium term basis, there's a I'd say that there are a number of indicators that would say it's probably sensible to be more cautious right now, just generally, over the next quarter or two, for a variety of reasons, not just seasonal, but as I mentioned earlier, the technical internals of markets and so on and so forth.
So finally, our allocation, as I said at the start, was you agreed that we're at a 2, which means we're underweight. A 4 would be neutral, 3 would be underweight, 2 would be more underweight, and 1 is as defensive as we get. What do you see as our likelihood next step? I mean, obviously it's impossible to predict, and it would depend on what's happening with the markets. We do these things not by calendar, not particularly in advance, but do you think it's more likely that we're going to add risk? Do you think there's a possibility if this rally continues and if markets look even more expensive, we could move to a most defensive position of risk level 1, which we held in 2021 but haven't held since?
So we talked about it the other day, or a couple of strategy meetings ago, about going to a 1, and I thought we felt that given our position within our equity exposure being already quite low risk, then to go to a 1 would be quite extreme for the portfolios, and whereas a 2 probably reflected a pretty strong cautious stance without the necessity to go for a 1, and that was our rationale then. I think it continues to be correct. I mean, we could have taken off some of our defensive position, and maybe that would have been right. But going forward,
it would have been helpful at the end of March.
Yeah, exactly. But going forward, I'd say seasonally, internally, there's a series of indicators, and even sentiment, which is one that we look at, which it's getting there. It's not quite there. I would say there are. It's pointing towards, at the very least, consolidation in markets, maybe sideways over the summer, and possibly a correction. And again, we discussed the other day what markets tend to do with new Federal Reserve appointees. Well, on average, the S&P goes down between 5 and 15%. So the summer could be interesting. I can't believe there's a huge amount of upside over the summer without some very positive news. You've got US politics is involved here, with midterms. Generally, that's not a great period either. So on balance, one would think that should something like that happen over the next several months, we'll be raising risk to a 3 and potentially to a 4 maybe in the autumn. That would be my best guess.
Excellent. Well, thank you, Eduardo. There we have it, a genuinely uncertain backdrop. Portfolios defensively positioned right now, with uncertainty, the whole host of uncertainties ahead of us. We'll be doing more of these videos. Hopefully that's interesting to you as listeners, gives you some insight of the way that we're thinking about portfolios. We tend to do these videos in the future. Please let us know any feedback that you have. And if you've got any questions at all, don't hesitate to contact anybody at Rivers. Thanks very much.